Often overshadowed by gold, it quietly plays a critical role in industry, technology, and monetary systems. But today, something feels different. Silver prices are approaching historic highs. Paper silver markets are under pressure, and recent signals from China are raising serious questions about whether the current system can hold. This video is not about hype or predictions. It's about understanding what is changing, why it matters, and what history can teach us about moments like this. For most people, silver trading today has very little to do with physical metal. The vast majority of transactions take place through financial instruments known collectively as paper silver. These include futures contracts, exchange-traded funds, options, and other derivatives that reference silver's price, without involving the direct exchange of actual bullion. In practical terms, this means silver can be bought and sold in enormous volumes without a single bar ever changing hands. This structure developed for efficiency. Paper markets allow industries, refiners, and investors to hedge price risk and plan ahead. Over time, however, these instruments began to dominate price discovery itself. As a result, the price most people see on a screen reflects the balance of contracts and promises rather than the immediate availability of physical silver. A critical feature of this system is leverage. Multiple claims can exist on the same ounce of silver, sometimes dozens or more, all assuming that most participants will settle in cash rather than request delivery. As long as confidence remains high, the system functions smoothly. Problems arise only when expectations change. If a growing number of market participants begin to question whether paper claims truly represent available metal, pressure builds quietly beneath the surface. What makes paper silver powerful is also what makes it fragile. It depends less on silver itself and more on trust in the structure that surrounds it. The pricing power of silver has long been shaped by large centralized markets where trading volume far exceeds the supply of physical metal. In these markets, prices are determined primarily through futures contracts, which are agreements to buy or sell silver at a later date, often without any intention of taking delivery. This mechanism allows participants to express views on price movements quickly and at scale, but it also means that silver's price is frequently influenced by financial positioning rather than immediate supply and demand. One of the most influential tools within this structure is short selling. Large traders can sell silver contracts they do not physically own, effectively increasing the apparent supply in the market. When done in large volumes, this can place downward pressure on prices, even if physical inventories are limited. Supporters of this system argue that it provides liquidity and keeps markets orderly. Critics counter that it allows price discovery to drift away from real-world conditions. What sustains this balance is settlement behavior. Most contracts are closed out financially before delivery is required. Cash settlement is faster, simpler, and avoids logistical challenges. Because of this, the market can function with far more paper silver than physical silver without immediate consequences. The system assumes that only a small fraction of participants will ever ask for metal. However, this structure is highly sensitive to shifts in behavior. When uncertainty rises, due to inflation, currency stress, or geopolitical instability, participants may begin to favor physical ownership over paper exposure. Even a modest increase in delivery requests can strain inventories and force price adjustments. At that point, paper markets no longer suppress volatility, they amplify it. The control exercised by paper markets is therefore conditional. It works best in periods of stability and trust. When those conditions weaken, the same mechanisms that once dampened price movements can become sources of rapid and disruptive change. Silver's price history is marked by long periods of relative calm, interrupted by sudden, powerful surges that catch most observers off guard. These episodes are rarely driven by a single event. Instead, they tend to emerge when economic stress builds quietly over time and then reaches a point where confidence in existing systems begins to fracture. Silver, often dismissed as secondary to gold, has repeatedly acted as a pressure valve during such moments. In the late 1970s, rising inflation and weakening trust in fiat currencies created fertile ground for a sharp repricing of precious metals. Silver moved rapidly as investors sought protection from eroding purchasing power. What made that period notable was not only the speed of the rise, but how unprepared markets were for it. Liquidity evaporated, and prices overshot expectations in a matter of months. The lesson was clear: once confidence breaks, silver does not move gradually. A similar pattern appeared decades later following the global financial crisis. Extraordinary monetary measures, near-zero interest rates, and large-scale asset purchases reshaped the financial landscape. In that environment, silver again attracted attention as a tangible asset outside the banking system. Between 2009 and 2011, prices climbed sharply, reflecting growing unease about debt levels and long-term currency stability. Once more, the move was concentrated in a relatively short window, following years of subdued trading. What connects these historical episodes is not speculation alone, but a shift in perception. Silver became a focal point when traditional assumptions about stability no longer felt secure. In both cases, paper markets struggled to absorb rising demand without significant price adjustments. The past does not offer exact templates for the future, but it does reveal a consistent behavior. When economic stress converges with tightening physical supply, silver has a tendency to reprice suddenly rather than smoothly. An all-time high in any market represents more than a numerical milestone. It marks a transition in how prices are formed and how participants behave. When silver approaches or exceeds previous peaks, the market enters a zone where historical reference points no longer offer guidance. Prior resistance levels, built over years of trading activity, effectively disappear. What replaces them is a period of price discovery, where value is negotiated in real time rather than constrained by memory or precedent. At these levels, psychological dynamics change noticeably. Sellers who previously relied on familiar ceilings to manage risk lose their anchors, while buyers gain confidence that the market is signaling something structural rather than speculative. For paper markets in particular, rising prices introduce operational stress. Higher prices increase margin requirements, raise the cost of maintaining short positions, and reduce the margin for error in systems built on leverage. Positions that were sustainable at lower price levels become increasingly difficult to defend. The significance of the upper 70s range lies in its proximity to historical extremes adjusted for modern market conditions. While nominal prices in past decades may appear comparable, today's silver market operates within a far more complex financial ecosystem, with larger volumes of derivatives and tighter integration across global exchanges. As prices rise toward these levels, the obligation to deliver or roll contracts becomes more visible, and the assumption that most exposure can be settled in cash begins to weaken. This environment often reveals the distinction between paper liquidity and physical availability. Even small disruptions in supply chains or inventories can carry outsized impact when prices are already elevated. Participants become more attentive to warehouse data, delivery schedules, and regional demand signals. The all-time high is therefore not an endpoint, but a threshold. It is the point at which price movement becomes less about technical trading and more about whether the underlying market structure can support continued demand without significant adjustment. China's role in the global silver market is often understated, yet it carries substantial weight because of how the country approaches strategic resources. Unlike speculative trading hubs that rely heavily on derivatives, China's engagement with precious metals is closely tied to physical supply, industrial planning, and long-term policy considerations. Import controls and licensing systems are central to this approach. When access to physical silver is adjusted through licensing, it is rarely a cosmetic or short-term decision. Silver plays a critical role in China's industrial ecosystem, particularly in electronics, solar technology, and advanced manufacturing. These sectors depend on reliable physical supply rather than financial exposure. When licenses are expanded or approvals accelerate, it signals a recognition that existing channels may not be sufficient to meet projected demand. This stands in contrast to paper markets, where supply can be increased instantly through contracts without any corresponding change in physical availability. Historically, periods of rising Asian physical demand have acted as early indicators of broader market shifts. In previous cycles, increased imports into China and neighboring economies preceded tighter conditions in Western inventories. The reason is structural. Physical metal moving eastward is removed from circulation within futures-driven systems, reducing the buffer that paper markets rely on. Once metal is absorbed into industrial use or long-term reserves, it rarely returns quickly. The importance of China's signal lies not only in volume, but in intent. Licensing. Mechanisms reflect planning assumptions made at institutional levels, often months in advance. They suggest preparation for sustained demand, rather than short-lived price movements. When such signals appear alongside elevated prices and growing strain in paper markets, they add another layer of pressure to an already complex system. The implication is not immediate disruption, but a gradual tightening that reduces flexibility and amplifies the consequences of any future imbalance between paper claims and physical reality. The tension between paper and physical silver ultimately comes down to the difference between financial abstraction and material reality. Paper silver exists within accounting systems that allow exposure to be created, adjusted, or closed with a keystroke. Physical silver, by contrast, is constrained by geology, infrastructure, and time. It must be mined, refined, transported, and stored. These processes impose natural limits that no financial innovation can bypass. For long periods, the gap between paper claims and physical availability remains invisible because most participants operate within the financial layer. Contracts are rolled forward, settled in cash, or offset before delivery becomes relevant. This creates the impression of abundant supply, even when inventories are tight. The system depends on predictability. As long as demand for actual metal stays modest, the imbalance does not surface. Pressure builds when preferences shift. Industrial users, sovereign entities, or long-term holders may begin to prioritize guaranteed access to metal rather than price exposure. Even a small change in this behavior can have outsized effects. Unlike paper markets, physical inventories cannot expand quickly to accommodate rising demand. Warehouses, refineries, and transport networks all operate within fixed capacities. As physical demand strengthens, paper markets are forced to respond. Higher prices become a mechanism to ration limited supply, discouraging marginal demand while attracting additional output over time. In the short term, however, supply remains relatively inelastic. This mismatch can lead to delays, backwardation, or growing premiums between physical metal and paper prices. These signals indicate strain, not failure, but they highlight how dependent the system is on continued confidence. The gap between paper and physical silver is therefore not inherently problematic. It is a feature of modern markets. It becomes significant only when trust erodes and delivery matters more than exposure. At that point, the abstract flexibility of paper contracts collides with the fixed realities of physical supply, and prices are forced to adjust accordingly. Discussions about specific price levels often attract attention, but focusing too narrowly on a single number can obscure the broader dynamics at work. The idea of silver reaching triple-digit prices is less about forecasting a precise outcome, and more about understanding the conditions under which significant repricing becomes possible. Markets do not move in isolation. They respond to shifts in confidence, liquidity, and structural constraints. When those elements change together, prices can travel much farther than conventional models suggest. In environments where paper exposure dominates, price ceilings tend to feel solid because supply appears abundant. However, when physical demand begins to assert itself, those ceilings become less reliable. The question then shifts from how high can the price go to what price is required to balance demand with available supply. In that context, higher prices are not speculative excess but a functional response to scarcity and risk. They serve to slow consumption, attract marginal supply, and restore equilibrium. Historical precedents show that once markets enter this phase, adjustments often occur unevenly. Long periods of compression are followed by rapid moves as participants reassess assumptions they previously took for granted. Price targets that once seemed extreme begin to appear less so when measured against inflation, adjusted benchmarks, expanding industrial demand, and the scale of modern financial exposure. What feels improbable in stable conditions can become plausible when the underlying structure shifts. It is also important to recognize that price outcomes are shaped by behavior as much as fundamentals. If market participants collectively anticipate tighter conditions, their actions can accelerate the process. Hedging strategies change, inventory policies are reassessed, and the preference for certainty over leverage increases. These feedback loops do not require universal agreement, they only require enough participants to alter their behavior in similar ways. Whether silver ultimately reaches a particular figure is uncertain, and certainty is neither possible nor necessary. What matters is recognizing that price potential expands when trust, supply, and structure realign. In such moments, markets are driven less by prediction and more by adaptation to new realities. Silver is not just an investment or an industrial metal. It sits at the intersection of money, technology, and trust. Paper silver works until it doesn't. History shows that when physical demand takes control, markets change quickly. What we are witnessing now may be another one of those moments. Not hype, not fear, just economics responding to reality. If you found this explanation helpful, let us know your thoughts in the comments. Like the video if you appreciate calm, factual breakdowns. And subscribe for more documentary-style insights into markets, money, and the real cost behind them. Disclaimer: this content is for educational purposes only and does not provide financial, investment, or trading advice.